Well, Enis, Matt Coyle, good to see you again.
Thank you for the invite.
Oh, great.
Excited about this.
Yeah, no, me too. I'm glad. This is the last time we spoke was probably about 2.5 years ago.
It was a long time ago.
I know. I think that
different time, different market.
Yeah, I think that was the early stages of COVID.
Yeah.
So I'm thankful those days are gone.
Yeah, me too.
So just want to introduce today's topic. We're going to talk about flipping. And
yes.
For our viewers, I just want to, Enis Shehu is a local boy who's made good. He's a owner-operator of a company called Whiteacre Properties. Mm-hmm. And he's been doing flipping since, I saw on your website, since 2008?
2008 is really when we started thinking about it actively, full-time. We started in 2014.
Okay.
Yeah, 2008, we actually back then we bought a restaurant, and that kind of took us out of the real estate business.
So restaurant, real estate, that's a good segue.
Yes, we sold the restaurant in 2012.
That's a tough business.
It was a tough business.
That's a very tough business.
Yeah.
What kind of restaurant, by the way?
Italian restaurant. It was a takeout pizza delivery.
Oh, okay.
Yeah, we bought it from an older gentleman that was retiring. And great business to start off.
So you've been doing it about 8 years then for now. Okay.
Yeah.
All right, good.
Yeah, full time since 2014.
And you're in Natick now, right?
The office is in Natick, yeah. Right on East Central Street, very close to you guys here. But
right. Yeah, we're in Wellesley office, so everyone knows. And Enis and I used to work together a little bit, and we had a chance to see up front what his style is, and good guy, very reasonable, very personable. I'm trying to build you up here, so
I guess, right? No, I appreciate that. No, it was definitely, we worked on a few leads back then, and we've been in touch since then. You guys have been involved in our business in different scenarios, right? On the lender side, and
it's a small world.
It's a small world.
Yeah. So let's just start off with the obvious question: how's business in the flipping market these days?
Yeah, it's right now business is tough. Being a flipper in 2022. We are recording this in October. It's tough. And I say that because interest rates are high. And now we're putting properties on the market that are not really selling as fast as 3-4 months ago.
Exactly.
So
what a difference 6 months has made.
Huge.
Huh? I mean, before sellers would dictate terms and effectively conditions or eliminate contingencies. And now, forget it. It's like buyer's revenge.
Yeah, no, it's totally different. You get a few people at the open house. You don't get those crazy offers from day one, and so
yeah, no, it is.
It's definitely a different market, and we're being careful. And we'll talk about how what I'm implementing, how I'm thinking about it. But it's definitely something to be careful moving forward. It's not an easy business to be in.
Do you think it's that much different than it was pre-COVID? COVID is when we saw where the seller basically dictated price and terms. Mm-hmm. But pre-COVID, I think it was more a balanced market where you'd have that normal friction between buyers and sellers.
Matt, honestly, no. I think even before then, like our finished product looks really nice. You have seen them, nice houses, they look great. And we price them right, meaning we look at what's selling on the market and we price them accordingly. And sometimes even under market, so we get a lot of people at the open houses. So we'll get offers right away, even back then, even before COVID, because the cost of money was low. People were coming in. Obviously, mortgage was low, right? So we're getting multiple offers, and by pricing it low, having a nice house staged, all of that, we would get multiple offers. So I think it was easier to sell back then. It's becoming more difficult right now because of the high interest. So there's still demand out there, right? There's still people wanting to buy, but they can't afford to buy these properties that I'm fixing at 7% interest. It just doesn't work for them.
Yeah, no, it's definitely creating an affordability issue, both from the inflated prices, because year over year prices are still going up, although at a decreasing rate.
Yes.
But they're still going up year over year, and then you got the double whammy of higher finance costs.
Exactly right.
So that's a and I don't and you and I were talking beforehand. I don't see that ending anytime soon.
Right, and that's why thinking of 2023 and looking ahead, we just got to be careful what we're buying up front, right? Because we don't know what the market is going to do in 6 months, so we have to be aggressive when buying these properties. And I buy everything off market, you know that. We call, we send direct mail, we knock on doors, talk to agents, and we're trying to buy properties at a discount up front so then we can renovate it and make a profit. So It's we'll see what happens, but
it must have been. We haven't talked in about 2.5 years, but it must have been difficult to get people to sell to you, and you give cash offers at a discount to what potentially the market value of that house could be, because you got to make a profit too.
Correct.
No, that's understandable.
Yeah.
But back when it was a seller's market, clearly a seller's market, was it hard to get buyers to sell because of that, or homeowners to sell because of that?
Extremely hard, because everyone knows the value of the property.
Right, exactly.
Everyone knows. You go online, you know the value of the property. You go on Zillow, right? You get a number. So people know that, and then they see our offer, which is 30% below market value.
Right.
You are going on 10 seller appointments to sign one deal if you're lucky, right?
Yeah.
And we only work with people that are really motivated by other factors other than price. Meaning, they want to close fast, they want an as-is sale, they want a guaranteed sale. They got to have strong motivation on terms.
That's a very specific customer, and they're not. It's not 30% of the population.
Absolutely
it's more like probably 1%.
Exactly right.
Yeah, but I see on your website these testimonials, and they seem very favorable.
Yeah.
So.
Well, that's because the terms that we offer. Typically, again, it might be under market value, but we're saying it's an as-is sale, so there's no repairs. You close on the date of your choice. You don't have to clean up. You don't have to get smoke certificates. You don't have to do any of that. It's a very easy process.
No, you make it very easy.
So people that like that and they're willing to trade equity for ease of transaction, they give us a break on price.
Now, on the website, it said you had you can give people cash within 7 days.
Yeah.
Is that? I thought it was like 30 days back when we were talking last, I guess.
We have closed in 72 hours, Matt. From the moment we sit down with somebody.
Beautiful. That's beautiful.
To the moment we exchange and sign on the deed, it was 72 hours.
And you make it easy. I know you do.
Yeah. And like, for example, this person that we closed that fast, they had an auction, a foreclosure auction. I believe it was a Friday morning. We went on the seller appointment on Tuesday morning. We had no other choice, so we had to do fast title search, get the money to the attorney fast. Everybody had to rush.
Right.
But if you have everybody aiming at the same goal, it can be done. 72 hours, we were done. The day of the auction, the people showed up for the auction, and we said, you know what, it's done, it's recorded, it's over.
That's great.
So the seller was happy, we got a great deal, and he avoided foreclosure.
You know what I love about this is, and we had a property recently on our block that was selling for under market value because I think Ying had mentioned to you.
Yeah, I saw that one, but it went on the MLS, unfortunately.
Right, correct, correct. On market, correct. But it amazes me. I had neighbors, not mentioning names, but we're trying to cajole other neighbors to enter into an investment and try and flip it themselves, and it just astonished me how easy people think flipping is. And I think I have flipped once, and you know the story, and I got to tell you, I have a lot of respect for what you do, and it's not as easy as people think.
No.
And it's very easy to get burned, but it's not easy to make money.
Yeah, it's a tough business. And you need to know a lot of different things. And obviously, for me, I learned by doing the work. It's not like my background is not in construction, none of that. And I went to college and have bachelor in business, right? So it's not something I was trained in, but I learned by doing the fix and flips, and it comes down to buying it up front at a good price.
Exactly.
So knowing the numbers, renovating it fast, so you don't, because every month we're paying high fees, right? To lenders and to the town for property taxes and all that stuff.
Time is the enemy.
So you got to turn it fast, and then now you're dealing with contractors. So now you have to figure out, are you spending $100,000 on the fix and flip, or are you spending $50,000, right? So you need to know that up front. And then you got to think about the sale price.
Oh, I think...
So it's a lot of moving parts.
I definitely buying it at the right price is very important.
Yeah.
But I also think the other part, and we talked about this last time, is getting a good sense of what it's going to cost to get that house in shape to sell at a premium above what you paid for it.
Exactly.
And I think that's the hardest part.
Yeah, that's a big question mark.
And I think that, and I was looking at your website and you use these terms, we were joking earlier, but I'll say it out loud for our audience. A cosmetic rehab versus a full gut rehab. So Why don't you explain what the difference is between those two
Yeah,
are?
no. So obviously, living in Massachusetts, you get a lot of older houses, right? A lot of houses were built in the early 1900s. Those houses haven't been renovated for a long time.
Exactly.
So you get one of these colonial houses that might look great. It has the square footage and all that, high ceilings. But then you start opening walls, and now it's like a can of worms, right? That turns into a full gut rehab.
It is,
right?
It is.
So what I mean by cosmetic is maybe you go and look at a ranch or a Cape Cod house built in the 60s. You change the flooring, you change the tile, you change kitchen and bathroom. To me, that's a cosmetic, right?
Okay.
Because we install new flooring, we paint, maybe update the cabinets or the kitchen.
Do you do many kitchen retrofits or?
We try to. Sometimes, just the panels itself, we take them out, paint, replace, whatever.
Yeah.
But kitchens are cheap enough for what we are installing that sometimes it's worth it just install brand new ones.
Right.
But that's what I mean by cosmetic instead of a gut rehab. Gut rehabs, we're spending $125 per square feet.
Well, give me an example. What do you mean by gut rehab? Like, what would you do? Like, what would be a red flag for you?
Yeah, taking a property, going and taking the house on the inside down to the studs. Right, so you go in.
Okay.
That's what I mean by gut rehab. It's taking it down to the studs, and now you got so you're replacing electric, plumbing. You're changing the layout of because that's the other thing. Back in the day, different needs and people lived in different ways.
Right.
Right now, everybody wants this open layout floor plan. So now you're changing floor plans.
So you're not looking for something where you're going to knock down walls because that's just too much.
That's exactly right, especially in this market. So I've done that. I got 3 projects right now where they're just like that, moving walls, building additions.
It's a lot of work.
It's a lot of work. So that means that you're also holding the property for too long.
Yeah.
And who knows where the market will be by the time I'm done, right? So that's the unknown, and I'm trying to avoid that. If I go and buy a ranch or a Cape Cod house, I know I'll spend $80,000 pretty much on experience by doing all the cosmetic work that I mentioned, maybe some exterior siding or roofing or windows, and then on the inside flooring and kitchen and baths. 80 grand, maybe 100. I can calculate that much easier than if I'm moving everything around.
Yes, there's this rule, and I sent you something on this before this interview. The 70% rule. And I think I saw something where you apply the 65% rule or so.
Correct. Yeah, the 70% rule is what I do pretty much every time I'm buying a property or submitting.
So 70% below the market value that you could achieve, I guess.
Yeah, so 70% is so we take the after repair value, which we think is going to be what we're going to sell the property for.
Correct.
After renovations. We do ARV, so after repair value times 70% minus the repairs.
Gotcha.
And that number will be our offer.
Gotcha.
So $100,000. Let's say $100,000 is what this property will sell for on the market once it's fixed up. 70% of that is 70 grand. Let's say we spent $20,000 to renovate cosmetics. Our offer is $50,000.
Gotcha.
That's the most we can spend on it.
Gotcha.
or pay for it. And we don't start there. We're negotiating with homeowners, so maybe we'll start at 35. And obviously, these are fictional numbers, right? Because we can buy anything for 35 grand.
Good luck.
Right?
Good luck. Good
yeah,
luck.
we can buy a shed for
That's
that much.
That's 1920s, yeah.
Right, but just for easy math, so we're starting at 30 or 40,000 to get to our max of $50,000.
Right.
So that 30% that I'm mentioning, that's not all profit. That's closing costs, that's commission on the sales side, that is lenders, all of that stuff, right? So the interest, the property taxes, and all that. So that's what that 30% covers. It's not just profit, because sometimes people are like, oh, you're killing it on this deal. It's 30% profit. It's not. If we're out of that 30%, we're aiming for 10 or 15% profit.
So when we were talking, I guess 6 months ago, when the market was still a seller's market and interest rates were more reasonable, what kind of returns were investors demanding, and what were you offering them?
Our lenders, people that we're working with?
Yes.
Excuse me, it's usually between 10 and 12%, depending on their needs and how fast of a loan, how long of a loan it is. But if someone gives us $100,000, they lend us to buy a property to fix and flip. At the end of the year, we give them $12,000 back as interest. So they'll walk away with 112 grand, right? So it's 12%. It's exactly $1,000 a month that they earn in interest for that $100,000.
Is that how long it takes to flip? A year?
Good question. It used to be 6 months. In average, for the last 2 years since COVID, we have actually been spending 8 to 9 months.
Is that because of supply chains?
That was one reason. Contractors are extremely busy.
Okay.
So getting guys to the job site has been more difficult than ever.
Right.
Because everyone is demanding. I mean, everyone is building.
But you have your own. You have your own guy, your construction manager, that helps you out with all
Correct.
that, right?
Yeah.
Which I think is. I think when we talked before, I think it's important to have someone who's dedicated.
Yeah.
You know, you can't wear all these hats.
I can't. No, I used to do that, and now I'm more in the office where someone else is the project manager on site. He moves around from project to project, making sure that our subcontractors showed up.
So you don't have like a plumber on staff,
No.
for example, but is your construction manager handy enough to like fill in the gaps if you need him to?
He will do handyman task. He
Okay.
knows framing. He understands the construction part.
Basic level.
Yeah, but he's not gonna do plumbing and electric. He's there more to make sure that he's supervising and get the schedule, get people to follow the schedule. You know,
So I got to believe that's
Yeah.
got to be a big help when you're
Huge.
navigating these projects, because
Huge.
you're trying to manage the finance
yeah,
and let him manage the construction component of it.
correct. And we got a lot going on at the office. I'm talking to lenders, right? I'm borrowing funds from lenders about this project, so I have to keep them updated. We have a rental property, so I have to talk to our property manager about issues with the rental buildings. What else? We have employees now. It's a team of 10. Those employees all have questions, so I gotta be.
Right.
So I can't be on the job site anymore. You know.
So back, I guess 6 months ago it was 10 to 12%, but rates have gone up like 300 basis points since then. So now we're probably looking at somewhere like 13 to 15, right?
It all depends. So far, it's interesting because we're still paying 12%.
Okay.
Our lenders haven't pushed on that too much.
But the real rate of return is much lower.
It's less for them, probably.
Yeah.
And hard money lenders, believe it or not, which are lenders that are lending on the hard asset, the house, not me personally, they are also in that same level. So they are keeping their rates low, regardless, what's going on with the interest rates.
No, I
and I
understand.
think because of that relationship that we've created, but sooner or later they'll probably also want to go up on price.
Well, I think what you have going for it, if you look at the other asset classes like stocks, corporate bonds, or even gold, the returns on them are negative or barely. I think gold's probably maybe 1 or 2%.
Yeah.
There's that people think that gold is a good hedge against inflation, and it's really not. It's all over the place. Sometimes it is, sometimes it isn't. Real estate is traditionally, though, has been a good hedge. Mm-hmm. But I think at some point in the cycle, if you have a long duration of high interest rates, a slowing economy, even that falters, and I think we're starting to see that now.
We definitely.
Returns are a lot less than they were 6 months ago.
Yeah.
So.
Yeah, no, and personally, with our lenders, we guarantee the 12%. So that's at least they know they're getting that money back because I'm borrowing. It's debt. It's not equity, right? So if I lose money on a deal, I'm still signing a promissory note and a personal guarantee. They know they need to be paid back. So to them, that's great. They know that they're going to get 12% when in the stock market.
I don't think people realize that is that if you don't pay, it's not like, well, I lost, you lost.
No.
Because these guys, you need to come back.
I promise them to give 12%.
You committed to this business model.
Correct.
And that's the big difference between someone who does it one-off versus what you're doing. Is you're treating it like a business, and you need to take care of your constituents.
Exactly right. And the fact that we have multiple projects, that's I think it favors me, because if one goes wrong, at least we got the others that can cover for it.
How many projects do you handle at one time?
Matt, it used to be 3 or 4. On the board right now, we have 7 active.
That's 7 active?
Right.
That's a lot.
It's a lot. With just we are a team of 3 on the construction side.
So do you pitch in with your construction manager on these? Because
everybody.
He's probably over maxed too.
Yeah. So he's maxed completely. He's overwhelmed. I am trying my best, and then we have an admin that's helping out, pulling permits, ordering materials, things like that. So it's again, on the construction side, it's just 3 of us. And then we got a bigger team on, the marketing acquisitions. We got someone in bookkeeping, a bunch of other people that are helping. We have a transaction coordinator.
Right.
So, but they're doing other things. They're not helping us on the construction side. So for a small team, we're doing a lot.
Yeah, I bet. Seven deals is a lot.
Yeah, and they are, we got ground up new construction, we got full gut rehabs, we got the cosmetic, it's all over the place.
Oh my God.
So it's a lot.
But are you trying to steer away from those full gut rehabs?
Yeah.
You are? Okay. Yeah. Is that the MO this
Correct.
going forward?
Exactly right. So I sent an email out to all our lenders, because someone reached out and said, hey, Enis, I'm a little worried with what's going on in the market. How is Whiteacre preparing for this? So I was about to reply to that person, and I said, you know what, let's copy everybody else, because every lender is probably wondering the same thing. And it's not like we have hundreds of people. It's usually, I think we have 10 or 12 people that we work with.
Right.
So I copied everyone and said, hey, this is what someone asked. This is what we are doing about it.
So you're trying to make it transparent.
Transparent, and the things that we talked about is let's focus on quick turnaround projects. Something we can buy right now and sell at the most in 6 months.
So 6 months is your target date.
6 months the most, correct. Okay. Because whatever happens in the economy, especially where we live, it's not like we're going to see a 20% drop in property values. I hope not.
When do you start worrying, though? Let's say give an example, and feel free to offer a different one, but let's say you finished a house, okay, 6 months, 9 months, whatever, it doesn't matter. And now you put it on market, and instead of selling in the first weekend of open house, it becomes 80 days. Do you start cutting price, or what do you do?
That's a good question. I think even from the beginning, Matt, we want to be aggressive on price. And we have done it before COVID. It's even more important right now. To give you an idea, so we had a property in Norwood. This was a few months back, but if we had the same property right now, I think we listed at $699. And then we got a $750 offer. Again, this was a couple months back.
That's great.
Now, instead of $699, if I have that same property, I'll probably list it at $649.
Yeah, exactly.
Right, but that's $50,000 difference there. That's typically my profit.
Yep.
But that's what we need to do in order to get a lot of people at the open house and maybe end up with 2 offers if we can, and get the best, right?
Yeah, no.
So that's the strategy. We're being aggressive on price, but if we have a property for 80 days, that would kill me. We have obviously, I'm not going to wait 80 days to do price adjustment. I'll probably wait 2 weeks to do a price adjustment, because I don't want to wait that long.
Do investors give you, pressure to sell as soon as you're done with a project?
Yeah, that's the goal. I think for them, the pressure comes once I'm getting close to the deadline of the loan.
Okay.
Because if I'm working with you and I'm telling you, hey, in 6 months I'll pay you back,
right.
Well, you're counting on that money to come back in 6 months.
Absolutely.
And if the project is not done, or at least even if it's done and it's sitting, I can't pay you back until I sell the property. So if it's taking that long, then you're going to start calling and be like, hey, what's going on? So they have been great. The lenders have been very flexible, and they're giving us extensions. But I just don't want to take that for granted.
No, I don't blame you. So is the typical investor agreement, lender agreement, like a year?
It's usually a year. And some projects that are very fast, we say 6 months, but those used to be aggressive terms. Now with a year, I feel more comfortable, yeah.
But you don't, like, let's say you sell a house, you buy and sell a house in 6 months.
Yes.
That 12%, is that just basically half of it, or
Correct.
you pay 12%? Okay, so you prorate it. Okay.
Prorated.
Okay,
Yep.
Makes sense. Okay, I wasn't sure if you wanted to be a hero and
I wish. Yeah.
and pay 12% regardless whether you 3 months, 6 months, or 12 months. So.
No, it's prorated to the.
I mean, that's not practical or reasonable, but
it's not. No, and again, with where we at right now and the profits that we're going after, it's not. It's everything. It's calculated, where it's a win-win all around. But it's not. It's not like we have that much spread to be like, hey, his interest for 12 months.
Agreed.
It's not feasible.
So you probably have to have a reasonable amount of cash reserves on hand for those potential deals that go south of what your expectations are.
Yeah.
Because you want to make good on your investors.
We have to.
Yeah.
We have to. So not only that, but think about
big responsibility.
Huge, and we are personally guaranteeing everything. It's me and Yoni, who is my brother
and
partner.
you ever break that guarantee, you're done.
And everything is on the line.
Yeah,
so
reputation's everything.
And we are happy to sign the personal guarantee. And you listen to different books and podcasts, and some of the big investors, they're like, oh, I never sign a personal guarantee.
Right.
To me, I'm guaranteeing that you get the money back, and that's my intention. So I'm happy to do that. But if things go sideways, again, you're pretty much everything is on the line, right?
Yeah.
No, so absolutely, we need to have extra cash, and I'm working at that. It's always hard because what happens is, first of all, you're buying properties and you're putting deposits down. You're putting offer deposits, PNS deposits, then buying the properties. But then what happens quite a bit is that we go over budget.
Right.
I mentioned 80,000 or 100,000 cosmetics. Well, we get into a project, we start opening walls, that 100,000 can easily turn into 150.
Yeah, yeah.
Or 200.
Right.
So where does that extra 50 or 100 grand comes from?
Correct.
Well, it comes from our funds.
Right.
So you got to be very careful that you know your budget in construction and have also contingency there for at least 15 or 20% if you can on top of that. So if you think you're going to spend 100 grand renovating a property, keep $20,000 extra just in case, because things will go wrong.
What do you think? You don't have to answer this, but what do you think your max a number of projects you could manage on a one-time basis? I guess right now you're doing 7. Before you start, that cash flow reserve you have is in jeopardy.
Yeah, I think we're at a max right now.
Okay.
I don't think we can do more than that.
Yeah, no,
it's
7
already,
seems like a lot.
It's putting pressure. Because this is the thing, like you can stop buying and we'll be fine. We can finish this 7, bring the cash, pay everybody, it's fine. But because we're always ongoing and we want to be active, we got a team that everybody obviously is trying to get deals. We can't stop, so you got to buy, right? So,
what's the minimum number of deals you need to do to keep because you got fixed expenses?
Yeah. Well, so last year we did, I think, about 30 deals, 32 transactions.
For the full year?
For the full year.
Oh, okay, good.
And then, but if we are somewhere in between 15 and 20, I think it's like our break-even point.
Oh, okay,
so,
good. Are your employees, is your employees salaried or are they?
So out of the 10, we have 5 on salary and 5 on commission.
Oh, okay, good. That helps balance it out.
Absolutely.
A little bit. So,
yeah.
So which towns do you think offer the most attractive?
Yeah.
Maybe that's a trade secret. Maybe you shouldn't tell me.
So. No, there are no secrets in real estate.
Don't worry, I'm not getting into business. Don't worry about it.
No, seriously, there are really no secrets whatsoever. People think that we're, I can't share our lenders or our contractors. There are no secrets. It's
honestly, there's enough barriers to entry than
exactly
to tell you where to buy.
Exactly right. So it all depends, because if you want to focus on nicer properties, ground up new construction, you probably should focus in Wellesley, Needham, Newton, right? That's not where I like to play because of the price point.
Right.
We do get projects in that area, and I do partner up with others, and we'll do the project, but it's not typically where I like to get involved in, because less buyers, cost of capital is higher, acquisition price is higher, so more dangerous. If you actually get started in a entry-level area, right, and maybe invest in buying Framingham or Holliston or Hopkinton,
so
right?
Define entry level in terms of price point. That's
price point,
$450,000
to $600,000.
Okay.
That's price point for us right now in Massachusetts, right? And it's just entry level.
So you're not interested in properties with $1 million number on it?
Not really.
I mean, selling at that would be great, but buying it,
no, because again, it means that you're buying at one. You're gonna put $200,000. You probably want to exit
a lot of money.
At 2. It's more dangerous, right? There's some developers that love that. That's their bread and butter. Perfect. They know how to do that. I'm comfortable with it. In a different market, and I like the market I'm in because there's so many more buyers.
Right.
Entry level, right?
I think you're right. I mean, look, people have to go down in price because of the affordability issue.
Right.
So I think what your strategy seems to make sense, at least on the surface. So
yeah. But as far as the town, we are buying wherever we find deals. I know some people will focus on towns like Lynn or Lawrence or I don't know, lower income areas, because they think on a situation like what's going on right now with the down economy, low income people will actually they'll have a hard time and they'll sell faster. They don't have equity, or if they don't have reserves.
Right.
So if they lose a job, they got no other choice but to sell the property.
Right.
So you see more people flipping in Brockton and Lynn and Lawrence and those low income areas compared to Wellesley, Needham, Newton, Lexington, right? So there's more transaction there, and it's entry level price point.
Right.
So it all depends. I personally would say if anyone's starting out investing, I say focus in your backyard. If I live in Framingham, I would probably just prospect in Framingham because you can go to the property fast, you can manage the job site.
And that's a good point thank you for bringing that up. Is if you try and flip a house that's like an hour away from you, it's a nightmare. It's a nightmare.
It's a nightmare managing
it completely.
Yeah.
Completely.
Because you can rely on contractors, but no one is going to care about the property like you care.
Yeah.
Right?
Yeah. No one's going to care about your own money than you do.
Absolutely. So
exactly.
Knowing the town you're investing in, the city and the people, it makes a difference. And then spread out, right? But like if I live in Framingham, if I want to invest in Lynn, it's tough. I don't know the town of Lynn. I don't know the streets. I don't know the people. You know, in Framingham, I can connect better.
Right.
I coach my kids soccer. Maybe we connect over soccer. Maybe we talk about whatever. You know, so I'm a Framingham guy. So talking about Lynn it's just going to be difficult.
Yeah,
so I tell people start where you at or where you live, and then grow from there.
So I thought I read on your website, or maybe it was a video that I heard, where you're talking about doing rental properties now as a way to, I guess, diversify from this flip. Because the income could be pretty good, and rents are going out of style right now. So,
we do own about 52 doors between apartments, and so we have been slowly growing.
What would you say, 52 doors?
Yeah,
I like that. So that's how you were 52.
Yeah.
Oh, good.
Yeah,
I like
we're
that.
on a goal to go to 100,
Good.
hopefully within a couple of years, and it helps because the rentals are building our equity, right?
Yeah.
Properties go up in value. They are paying our mortgage down, which is great.
That's even
and
better.
That's how we building wealth. The fix and flip is great.
Passive income,
it's
building
passive
equity,
income. The tax benefits are huge.
Right.
We take a lot of depreciation from these rental buildings to offset our income from the flips.
Right.
I mean, fix and flip is an active. That's how they consider it's active income. So you are taxed at the highest bracket.
Yeah.
So instead of us paying a lot, thank God we got the rental. So we are investing into rentals. I would like to buy more. Again, looking for deals. That's
probably hard to come by. So,
right.
But that's good. No, that sounds like a. What is a rental? What is a multifamily these days? Is it at least four units? Or
residential 4 or under.
4 or under. Okay.
Commercial would be 5+.
Okay, gotcha. Okay, I thought that was the case.
Yeah.
And then the last question I want to ask you was mistakes that most people make in this business.
Yeah.
Any war stories you have?
I think we touched on a few, Matt. I think a lot of people starting out can't calculate numbers the way the real numbers, right? There's a lot of wishful thinking.
I think there is.
I think people starting out need a good agent, someone that can tell them the numbers correctly. Hey, this is what it can sell for. This is what repair, and a good agent should also know about repairs. I know agents are not contractors, but they should have resources to be like, hey, this project will be costing you X amount of dollars.
Or at least call someone in to give you an assessment.
Or get connected to somebody that knows that.
Right.
And then you can run numbers and be like, hey, if you pay more than that, it's going to be a tough project to make a profit, right? So have somebody that it's knowledgeable to guide you through that.
Right.
And sometimes, because there's a lot of guys and gals trying to get into the business, they'll pay whatever it takes.
Exactly.
They'll pay whatever market price they see on the listing on the MLS, right? Just to get going without knowing what they're gonna get paid at the end.
Right.
And a lot of people have been thinking that because the market appreciated so much, whatever they do, even if they over improve the property or whatever, they're still gonna make a profit. That's not the case anymore.
It's like that guy in the taxi cab who's talking about all the stocks that he's invested in, and you're thinking, well, maybe it's time to get out of the market. So.
right, yeah.
So,
no, the funny thing is that I was at, forgot where I spoke to someone, and he was a barber, and he had just bought a 3-family in Boston to fix and flip. And I'm like, you are not even in the business. How did you make the decision? So that shows you that everybody was fix and flipping, right? So, but to go back to the mistakes, I think not understanding the numbers up front and jumping into it because everyone is doing it.
Right.
That's a mistake. I see a lot of people over improving properties. meaning, you know, you take a ranch in Framingham and you want to make it like a beautiful house that should sell in Wellesley.
Right.
Well, those are two different markets.
They are very different.
Right? So you do in Framingham what it's selling in Framingham. So you got to look at the finishes for that area.
You do.
You know, so you don't do quartz countertops maybe. You don't do the high, you know, the latest model of appliances, things like that.
Right.
Because you're not going to get your money back for that.
Right.
So a lot of people were doing that. And the last thing I want to mention is people then putting the house on the market because they spent so much buying it and renovating it. Now they're overpricing it, thinking, oh, well, I spent 600,000 so far. I'm going to list it for 7 because I've spent 600. When actually market value may be 600,000.
Right.
That's never.
Well, that's a common mistake people make. They said, I put 100,000 in my house.
Exactly.
So it doesn't matter what you put into it. The market's going to pay what the market's going to pay.
Correct.
So
exactly right, and that's wishful thinking. They're
it
thinking
is wishful thinking. Yeah.
That's gonna and unfortunately you got one chance at listing the property and making the best impression you can. So you got to do nice photos. You got to do the staging. You got to price it accordingly. If you miss any of those 3, now you're sitting, especially in this market. So don't make those mistakes.
You got to move it. Great. Well, thank you very much for your time.
This is
Appreciate
great.
it. Okay?
Yeah. Thank you.